Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 42. 5 portfolios experience the following results during a 7-year period. A, B, C, D and E 5 portfolios are given. Average annual return is given, and then the standard deviation and the correlation with the market returns are given. And the market risk, nothing but standard deviation of market is given 1.2, and the market rate of return also is given 14, and the risk-free return is 9%. Rank the portfolios using Sharpe model, Trainers model, and then Jensen's alpha. Okay, in the previous video we have clearly seen what is Sharpe model and Trainers model for the 41 sum. So we'll majorly focus on this Jensen alpha. Sharpe method and Trainers method is nothing but the extra return which we are earning for the per unit of risk, per unit of total risk in case of Sharpe method, and per unit of systematic risk in case of Trainers method. Jensen alpha is nothing but the extra return which we are earning compared to the required rate of return as per CAPM model. That's what Jensen alpha says. Okay, proceeding further, we have the required return of the portfolio and the standard deviation, and we have risk-free return also. So using this we can directly find out Sharpe model without any this thing. So 19 for A, 19 minus 9 divided by 2.5, 4, then 3 in case of B, 7.5 in case of C, 4.25 in case of D, and E, 4.5 in case of E. The highest one is portfolio C, which gives us 7.5% extra return for per unit of risk which we are taking. Going next, it is E and then D and then A and then B. Now for Trainers method, it is only the systematic risk portion. So it is the extra reward or extra return which we are earning per unit of systematic risk. So for systematic risk we need beta. So beta can be found out by using the covariance approach. Covariance divided by variance. Covariance of the stock with the market and variance of the market. So covariance of this is nothing but standard deviation of the portfolio multiplied by the standard deviation of market multiplied by correlation coefficient of portfolio with market divided by the standard deviation variance of market. With this standard deviation and the denominator can be eliminated, hence arriving at this formula. That's what ICAI solution also used here. So using this formula we can find out the beta for all the portfolios, as we have the standard deviation of the stock, then standard deviation of market, and then correlation coefficient of all the portfolios. So 1.75, 0.9, 0.65, 1.25 and 9 will be the beta. And using this we can find out the Trainers method, wherein instead of total risk the denominator is substituted by the beta, which is the systematic risk portion. Here we are getting the values of 5.71, 6.67, 9.23 for C and 6.8 for D and 9 for E. Hence accordingly the rank also changes. The highest return, the highest extra return which we are earning for the systematic risk comes from portfolio C, which gives almost 9.23% extra return for every unit of systematic risk which we are taking. Now the third requirement is Jensen's alpha. Is nothing but the actual return minus the required return as per CAPM. So we have the actual average annual return, but we need to find out the required portfolio return as per CAPM model, which is nothing but RF plus beta of portfolio multiplied by RM minus RF, wherein this RM minus RF is the market risk premium, and RF is the risk-free return. So with risk-free return, if we add up the risk premium, we'll get the required portfolio return as per CAPM method, capital asset pricing model. Once we got the return from the portfolio, which is the required return as per CAPM, we have to reduce it from the average annual return to get the extra return which we are earning compared to the theoretical return by CAPM. So in case of A it is 1.25, B it is 1.5, C it is 2.75, and D it is 2.25, and E is 3.6. Hence the rank also changes accordingly. Thank you.